What happens when the world's largest economy starts a trade war with its closest allies? We're about to find out, and it could affect your investments no matter where you live. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, and everything related to growing your wealth for international investors. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. Today, I'm diving deep into a story that's shaking global markets and could impact your portfolio, whether you're in Singapore, London, Tokyo, or anywhere else in the world. On Friday morning, President Trump dropped a bombshell that sent shockwaves through financial markets worldwide. In a single social media post, he threatened to slap a massive 50% tariff on all goods coming from the European Union starting June 1st. To put this in perspective, imagine if every European car, wine bottle, or piece of machinery suddenly became 50% more expensive in America overnight. The reaction was swift and brutal. European stock markets crashed, and even US markets weren't spared. If you're an international investor with exposure to European or American stocks, you felt this pain immediately. But here's what makes this story fascinating for global investors like us. This isn't just about America and Europe. This is about understanding how the world's largest economy uses trade as a weapon, and how that affects every market on the planet. Think of international trade like a massive game of chess, where every move affects the entire board. Trump's frustration with Europe isn't new. It's been building for years, and understanding his mindset helps us predict what comes next for global markets. Trump has repeatedly called the EU nastier than China and claimed the bloc was formed in order to screw the United States. His main complaints? The US imports far more from Europe than it exports back. That's a trade imbalance Trump wants to fix. But there's a deeper game being played here. Trump's team isn't just angry about trade numbers, they're frustrated with how Europe negotiates. American officials want quick deals and concrete commitments. European officials prefer careful consultation with all 27 member countries before making decisions. It's like trying to negotiate with one person versus trying to get agreement from an entire committee. The real kicker? Trump wants Europe to join America in putting pressure on China through tariffs. The UK already agreed to impose tariffs on Chinese steel as part of their trade deal with the US. But Europe, which sees China as a crucial export market, has been reluctant to pick sides in this economic Cold War. Here's where this gets personal for tech investors worldwide. Trump didn't just threaten Europe. He also warned that any products not made in America would face significant import taxes. This creates a fascinating puzzle for international investors. Major tech companies' stocks are held in portfolios around the world, from pension funds in Canada to sovereign wealth funds in the Middle East. If companies have to choose between paying massive tariffs or completely restructuring their global supply chains, what does that mean for their profitability? The irony here is striking. Trump is essentially forcing American companies to abandon the global supply chains that made them profitable in the first place. It's like telling a restaurant chain they can only source ingredients from one expensive local supplier instead of shopping globally for the best prices. The European Union's response tells us everything about how smaller economies deal with economic superpowers. EU Trade Commissioner Maros Šefčovič said trade must be guided by mutual respect, not threats. But behind this diplomatic language lies a carefully calculated strategy. Europe has already prepared countermeasures worth billions in retaliatory tariffs, but they're holding fire for now. They've also prepared a second wave targeting even more American goods if negotiations completely break down. This is economic warfare by other means. Each side threatens to make the other's exports more expensive until someone blinks first. For global investors, this creates opportunities and risks. European companies that export to America will face immediate pressure if these tariffs go through. But European companies that compete with American imports might actually benefit from making American goods more expensive in European markets. Here's the part most international investors miss. This isn't really about Europe at all. It's about China. Trump's trade strategy is designed to force America's allies to choose sides in the economic competition with China. Think of it like a schoolyard where the biggest kid is trying to get all his friends to stop playing with the new student. This strategy has already worked with the UK, which agreed to impose tariffs on Chinese steel to secure their trade deal with America. But Europe, with its complex decision-making process involving 27 countries, moves much slower than Trump's deal-making timeline allows. If you're an international investor, here's how to think about this situation. First, currency effects will be massive. A trade war between the US and Europe could strengthen the dollar while weakening the euro, affecting the value of any European investments when converted back to your local currency. Second, sector rotation becomes crucial. European automakers could get crushed by high tariffs, but European companies that serve local markets might actually benefit from reduced American competition. Similarly, American companies with significant European operations could see their costs skyrocket. Third, supply chain disruption creates both winners and losers. Companies that have already diversified their supply chains away from trade war hotspots might outperform those still dependent on cross-Atlantic trade. The smart money is already positioning for this. This trade dispute reveals something crucial about how modern economics really works. We live in an interconnected world where a social media post from one leader can instantly wipe billions off global stock markets. The old rules of international cooperation are being replaced by transactional deal-making where economic relationships become bargaining chips. For international investors, this creates a new reality. Country risk isn't just about emerging markets anymore. Even developed economies can suddenly become investment risks based on political decisions. The US-EU trade relationship, worth over $1 trillion annually, is now subject to the whims of social media diplomacy. This also shows us the power of economic interdependence. Europe can't simply ignore American threats because the US market is too important. But America can't completely alienate Europe because they need allies in their competition with China. It's a delicate balance that creates opportunities for savvy investors who understand the underlying dynamics. Treasury Secretary Scott Bessent said he hopes the tariff threat will light a fire under the EU. This suggests the 50% number might be a negotiating tactic rather than a final position. But here's the thing about negotiating tactics. Sometimes they become reality if the other side calls your bluff. The timeline is crucial for investors. Trump wants these tariffs to start June 1st, giving negotiators just days to reach a deal. European officials are scrambling to arrange high-level talks, but their consensus-building process takes time that Trump might not give them. The market reaction tells us everything about investor sentiment. When European stocks crashed and American futures fell, it showed that investors believe this threat is credible. Smart money doesn't panic over empty threats. They're pricing in real economic damage. So what should you do with this information? First, diversification becomes even more critical. Don't put all your eggs in either the American or European basket when trade wars can erupt overnight. Consider adding exposure to markets that benefit from US-EU tensions, like Asian economies that could capture diverted trade flows. Second, focus on companies with pricing power. In an inflationary environment created by tariffs, companies that can pass costs to consumers will outperform those with thin margins. Look for brands with strong moats that customers will pay premium prices for, regardless of tariffs. Third, watch the currency markets. Trade wars create currency volatility that can either enhance or destroy your returns when converted back to your home currency. Consider hedging strategies if you have significant exposure to either dollars or euros. Finally, stay informed, but don't panic. Trade negotiations are like watching sausage being made. The process is ugly, but deals often get done at the last minute. Trump's negotiating style relies on creating crisis to force quick decisions. Understanding this pattern helps you separate noise from genuine market-moving events. The key insight for international investors is that we're entering an era where economic policy becomes foreign policy. Trade relationships that seem stable for decades can change overnight based on political calculations. This creates both risks and opportunities for those smart enough to position themselves correctly. Remember, every crisis creates winners and losers. The companies and investors who adapt fastest to this new reality will be the ones who profit while others struggle to understand what just happened. That's a wrap on today's deep dive into the Trump-Europe trade war and what it means for your investments. If you found this analysis helpful, smash that like button and subscribe for more insights into how global events affect your portfolio. Next week, I'll be breaking down how to identify companies that actually benefit from trade wars. Because while most investors panic, smart money finds opportunity in chaos. Until then, keep investing smart, and I'll see you in the next one.